All right, let's dive right into this explainer. Today, we are putting on our expert investment analyst hats to run NextNav, a seriously futuristic 5G infrastructure stock, through an absolutely rigorous stress test. We're taking this pre-profit company, whose entire core value is locked up in invisible airwaves, and seeing how it survives against the most ruthless, time-tested financial frameworks in investing history. Here is our roadmap for the analysis. We'll kick things off with a quick company snapshot, run the numbers through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, crunch the data with a DCF model, and then wrap it all up with our final synthesis. Section 1. Let's get a fundamental reality check with our company snapshot. Before we get into the heavy math, let's look at the baseline data we pulled from our stock data file for ticker symbol NN. And wow, there's a massive contradiction right out of the gate. NextNav has a market cap hovering around $2.94 billion, but get this, their price-to-sales ratio is an eye-watering 729.8x, and earnings are negative, giving us a negative 15.2 PE ratio. I mean, think about that. You are essentially paying almost $730 for every single dollar of sales this company makes. For any traditional value investor, that is an immediate blaring siren. So why the multi-billion-dollar valuation? Well, NextNav is a pre-profit innovator playing in the 3D geolocation and 5G positioning space. They're sitting on a massive, highly valuable intangible asset, 4 billion megahertz pops of spectrum in the 900 megahertz band. They also recently proved they can achieve an insane 20 nanosecond timing accuracy in real-world tests. Their big, overarching goal? To become the ultimate terrestrial backup to the GPS system. But, and this is a huge but, they are currently waiting on the FCC to actually approve their commercial rollout.
Moving right along to Section 2, let's look at this through the Warren Buffett lens.
Buffett loves a deep economic moat, and surprisingly, NextNav actually passes that test. Their unique government-issued spectrum licenses create a massive barrier to entry. Nobody's just going to casually replicate that lower 900 megahertz footprint. But the good news basically stops there. Buffett demands consistent, predictable earnings, which they absolutely do not have. And while you might spot a return on equity of a positive 219.5%, don't be fooled for a second. That number is completely skewed by an accumulated deficit, meaning negative equity. It's just a quirk of the math, definitely not fundamental business strength. Looking closely at their financials, the standout number is a massive net loss of $189.2 million for the year 2025. You know, Buffett's entire philosophy hinges on calculating intrinsic value through owner earnings, the actual tangible cash a business puts in the owner's pockets. With NextNav, those owner earnings are deep, deep in the red. Because Buffett requires a wide margin of safety based on positive cash flow, you simply can't calculate one here. Honestly, he wouldn't touch this stock at any price right now. And just to really hammer home how big this profitability gap is, their operating margin is currently sitting at a jaw-dropping negative 1,913.9%. They are burning through cash for research, development, and a heavy regulatory push, while bringing in just over $4.5 million in revenue for 2025. For the Oracle of Omaha, who wants proven, cash-flowing machines, this is a total deal breaker.
All right, part 3. Let's pivot and see how Peter Lynch would categorize this growth story.
Lynch was legendary for categorizing stocks to understand their specific trajectory. For NextNav, he would strictly label this an asset play. Their financial notes heavily feature highly valuable intangible assets, specifically FCC wireless multilateration location and monitoring service licenses. An asset play is basically a company sitting on something incredibly valuable that the market might be completely overlooking. If the FCC approves their petitions, those spectrum assets could explode in value, totally overshadowing what's currently on the balance sheet. But here is the catch. Lynch loved under-the-radar stocks with low institutional ownership, right? He wanted the everyday investor to beat Wall Street to the punch. Well, NextNav's institutional ownership is a whopping 79.16%. Over $116 million from big institutions flowed in over the last year alone, alongside $90 million in outflows. The secret is definitely out. The smart money is already crowded in, actively trading on every whisper of regulatory news. So what's the ultimate Lynch verdict? Well, the institutional crowd is already there. And while the data shows a PEG ratio of 0.2x, that number is wildly skewed because it relies on highly speculative 2028 projections rather than a solid history of stable growth. Now, they do have a decent balance sheet right now with about $143 million in cash to keep the lights on and weather the storm,
But ultimately, Lynch would probably rate this a highly speculative hold, or maybe even a sell. He would want to wait to see real, actual revenues flowing from those assets before jumping in.
Section 4. Time for the ultimate ruthless stress test, the Benjamin Graham Defensive Investor Checklist. Graham is all about playing it safe. And to be fair, NextNav does check a couple of boxes. They've got adequate size with that $2.94 billion market cap and strong short-term liquidity with a solid current ratio of 10.5x. But then we hit a brick wall. NextNav explicitly states they have zero record of paying cash dividends, and their earnings stability is essentially non-existent.
Graham's famous intrinsic value formula is based on cold, hard math and tangible assets. He multiplies 22.5 by the earnings per share and then by the book value per share and takes the square root. It is designed specifically to uncover deeply undervalued companies trading below their liquidation value. But here is where things get completely wild. When you plug in NextNav's negative 1.42 EPS and combine it with their massive accumulated deficit of over $1 billion, the math literally breaks. You simply cannot calculate a margin of safety here. Because Graham strictly requires a solid history of positive earnings and positive equity, this company doesn't even compute in his investment universe. He walks away immediately, assigning an intrinsic value of absolute zero.
Okay, Section 5. Since the backward-looking classical models basically short-circuited, let's pivot to some forward-looking quantitative models, starting with a discounted cash flow.
To build a DCF for a pre-profit company like this, we have to make some massive explicit assumptions. Because their current free cash flow is deeply negative, we are bridging all the way out to 2028, using simply Wall Street's projections of $2.3 million in revenue and roughly $285,000 in earnings. Plus, given the massive execution and regulatory risks tied to the FCC, we have to apply a really high tech industry average weighted average cost of capital, or WACC. Finally, we're assuming a perpetual growth method post-2028, imagining a future where their network has become a standard, essential utility. When we run those numbers through a sensitivity table using a strict 12% WACC to account for the risk and a conservative 3% terminal growth rate, our base case model yields a fair value of exactly $20 a share. At its current price of roughly $21.55, that means the stock is actually pretty fairly valued, assuming those wildly optimistic long-term projections actually pan out. But if we look at other forward-looking models, the spread is just crazy. The median Wall Street analyst consensus is way up at $39.50. They are fully pricing in the upside of NextNav becoming the military's primary drone sensor and the nation's GPS backup. On the flip side, retail community sentiment is all over the place, swinging violently from 39 cents all the way up to $27. It just shows how incredibly polarized the market is on this massive binary regulatory event. Finally, Section 6. Let's synthesize all these wildly different frameworks and make our final call. Just look at this massive disparity. How do we reconcile the old guard with the new school? Benjamin Graham looks at the cold, hard balance sheet today and sees literally zero fundamental value. Our base case DCF looks at the long road to 2028 and sees a fair value of $20. And the growth-obsessed analysts look at the ultimate spectrum monopoly potential and see an almost $40 upside.
So, bringing all our expert analysis together, the classical value titans, Buffett and Graham, trigger a rock-solid sell at $21.55 because they demand cash flow and safety today. Lynch sees a crowded trade with too much institutional money, making it a cautious hold. But if you align with the forward-looking tech analysts and DCF models, it's a speculative buy, banking entirely on those future FCC approvals, unlocking the true value of those 4 billion megahertz pops.
We'll leave you with this provocative thought to chew on. As an investor, are you willing to throw classical financial safety completely out the window, ignore Graham's strict math, and bet the farm on the invisible infrastructure of tomorrow? The payoff for securing a nationwide GPS backup could be monumental, but paying 730 times sales to find out, well, that is the ultimate leap of faith.